The quest for gold, navigating the landscape of gold ETFs. Gold, the glittering allure of ages, has long held a captivating position in history and finance. In today's tumultuous economic landscape, its appeal as a safe haven has only intensified. Investors seeking to hedge against market volatility and diversify their portfolios increasingly turn to gold, often through the convenient avenue of gold exchange-traded funds, ETFs. Yet, with a plethora of options available, discerning the best gold ETF can be a daunting task. This article delves into the intricate world of gold ETFs, equipping investors with the knowledge necessary to navigate this terrain. We'll explore the essential factors to consider when choosing a gold ETF, compare popular contenders, and unveil strategies for incorporating gold into a diversified portfolio. By the end, you'll be armed with the insights to confidently embark on your own quest for gold within the ETF landscape. Understanding gold ETFs, a foundation for success. Before embarking on our exploration, it's crucial to establish a firm understanding of what gold ETFs entail. Essentially, a gold ETF tracks the price of gold, allowing investors to gain exposure to the precious metal without the physical hassles of buying, storing, and insuring it. These ETFs hold physical gold bullion in secure vaults, and each share represents a specific amount of the underlying gold. The advantages of opting for a gold ETF are numerous. First, it eliminates the logistical challenges of owning physical gold, offering greater convenience and security. Second, it facilitates fractional ownership, enabling investors with smaller budgets to participate in the gold market. Third, ETFs provide liquidity, allowing for easy buying and selling on exchanges. However, not all gold ETFs are created equal. Several key factors differentiate them, and understanding these nuances is crucial for selecting the most suitable option for your investment objectives. Essential factors to consider: unveiling the best fit. Delving deeper, let's examine the critical factors that shape the landscape of gold ETFs. 1. Underlying asset. Physical gold ETFs. These hold actual gold bullion in insured vaults, backing each share with a specific amount of the precious metal. This offers the closest link to actual gold ownership, though storage and insurance costs might be factored into expense ratios. Gold futures-based ETFs. These track the price of gold futures contracts instead of holding physical gold. While they offer leverage and potentially lower expense ratios, they expose investors to counterparty risk and potential tracking errors. 2. Expense ratio. This annual fee, expressed as a percentage of assets under management, covers the ETF's operational costs. Lower expense ratios translate to higher returns for investors. Ideally, aim for an ETF with an expense ratio below 0.50%. 3. Liquidity and trading volume. High trading volume ensures easy buying and selling of ETF shares, minimizing bid-ask spreads and market impact. Opt for ETFs with average daily trading volume exceeding $100 million. 4. Custodian reputational. The security and integrity of your gold holdings ultimately hinge on the ETF's custodian. Choose ETFs with reputable custodians who adhere to strict security protocols and independent audits. 5. Additional features. Some ETFs offer unique features like currency hedging, leverage, or exposure to specific gold mining companies. Consider these features in alignment with your individual investment strategy and risk tolerance. Comparative analysis, unveiling the contenders. Now, let's turn our attention to some of the prominent gold ETFs in the market, analyzing their strengths and weaknesses against the backdrop of the aforementioned factors. 1. SPDR Gold Shares. GLD boasts the largest asset base and trading volume, offering unparalleled liquidity and ease of trading. It tracks physical gold with a competitive expense ratio of 0.04%. However, its lack of hedging might expose investors to currency fluctuations. 2. iShares Gold Trust. IAU similar to GLD. IAU tracks physical gold with a slightly higher expense ratio of 0.07%. It boasts a strong track record and enjoys widespread popularity among investors. 3. VanEck Vectors Gold Miners ETF, GDX, for those seeking broader exposure to the gold sector, beyond just the metal itself. GDX offers an avenue. It tracks a basket of gold mining companies, potentially amplifying gold price movements, but also introducing additional company-specific risks. 4. SPDR Gold Minishares Trust, GLDM, for investors with smaller portfolios. GLDM offers a smaller share size, facilitating fractional ownership of gold. Its expense ratio is slightly higher at 0.18%, and its trading volume is lower than its larger counterparts. Strategically adding gold, blending hedging and growth. Diversification Shield. A small gold allocation, 5 to 10%, can act as a hedge against market downturns, as gold tends to move inversely to stocks and bonds. This can provide stability and protect your portfolio during periods of financial turbulence. Strategic hedging. For investors anticipating specific economic events or market scenarios that might negatively impact traditional assets, a larger gold allocation, 10 to 20%, can serve as a more potent hedge. However, such a strategy requires careful monitoring and adjustments based on evolving market conditions. Growth potential. While not its primary function, gold has exhibited periods of robust price appreciation. For investors seeking long-term growth opportunities, a strategic allocation to gold ETFs focused on specific regions or emerging gold producers can potentially offer upside potential alongside diversification benefits. Beyond the ETF, unveiling alternative avenues. While gold ETFs offer a convenient and accessible approach to gold investment, alternative avenues exist for those seeking deeper, albeit potentially more complex, exposure. 1. Physical gold. For investors seeking direct ownership and tangible security, holding physical gold bars or coins remains an option. However, storage, insurance, and liquidity considerations must be factored in. 2. Gold futures. For experienced investors with risk tolerance for leverage and complex trading strategies, gold futures contracts offer potential for amplified gains or losses. 3. Gold mining stocks. Investing in individual gold mining companies can offer leveraged exposure to gold prices, but also introduces company-specific risks and requires meticulous research and due diligence. Conclusion: the golden voyage awaits. The quest for gold within the ETF landscape can be enriching and rewarding. By equipping yourself with the knowledge and insights outlined in this article, you can confidently navigate the terrain, select the most suitable gold ETF for your investment goals, and strategically incorporate this shimmering asset into your portfolio. Remember, the journey for gold is not a sprint, but a strategic voyage tailored to your individual financial roadmap. So, chart your course, set your sails, and embark on your own quest for gold within the boundless possibilities of the ETF universe.